The Coca-Cola Company, they're one of the most storied brands in the world. And after it began in 1892, the Coca-Cola Company has in many ways seen nothing but success. However, if you look just underneath the surface, we can understand what the recipe for success has been for Coca-Cola, which is not nearly as secret as the famous secret recipe that makes Coke what it is. In addition, we can walk through some of the things that Coke has done strategically in the past to set them up to be the company that they are today, some of the pieces of their business model that are the non-negotiables, and what we think Coke will need to do to maintain its success and competitiveness in the future. And because Coke has such a compelling product and a compelling brand, we can tell one thing about it. The brand and the brand story have driven some element of the success. But what part of the business model does branding impact? Coke gives us some real clues. The Coca-Cola Company began with the sale of a product, Coca-Cola, named after its two primary ingredients, coca leaves and the cola nuts. And Coca-Cola grew into more than just Coke with multiple different brands that they built or acquired. Coca-Cola acquired Minute Maid in 1960, and in 1982, they bought Columbia Pictures. The two of those seem like they're not similarly related, but what's the common link? Both of them are long and storied brands. But in their disposition of Columbia Pictures and their focus on products, namely beverages, Coca-Cola has refocused on what makes them powerful at who they are. They take a product, they build a brand around it, and they mark up the product because of the brand. The success of Coke is driven by this common formula, and they have now applied it to multiple different acquisitions. In fact, they have purchased beyond Minute Maid other organizations such as the Odwalla brand of fruit juices, Barks in 1995, Fuse Beverage, the Honest Tea Company, Zico, a coconut water company, Monster Beverage, and in fact, one of their most recent acquisitions was the hipster brand Topo Chico, the Mexican sparkling water. Because of all of these different areas, Coke has done an incredible job of distributing and marking up these very low cost to produce products into something that are compelling products that people enjoy, repeat, and consume, and in fact differentiate against other brands because of. So the branding power of Coke has these two purposes. Number one, command a premium price. Number two, bring people back because of the brand story over and over again. Get them onto a product, get them to like it, know it, and have it feel familiar, and then have it repeat itself. And so those two things, good margins and high volumes, have been the recipe for success for Coke. So it makes sense that Coke would have divested of Columbia Pictures because Columbia Pictures, as a primarily fixed cost business, didn't have the same synergies, the same process, or the same recipe for success as its other brand promises have. Now that's what has made Coke what it is today. This recipe of build a product, build a story, build a following, charge a premium. But will Coke in the future be able to sustain this? We can get some clues by looking at Pepsi. In the mid 20th century, Coke had over 60% of the market share in the US. But when Pepsi entered the market, that began to erode. Pepsi follows a very similar formula, but the formula for Pepsi is different because they don't just use it on beverages, they use it on snack products too, which they went into in a big way when they acquired Frito-Lay. So similar process for Pepsi, but in many ways larger scale because they have two categories that they're working across. The Coca-Cola Company in the last couple of years has faced challenges because of this growth of Pepsi, the Pepsi brand, and the Pepsi increase in its influence, especially in international markets. And we can see that by taking a look at their financial statements. One of the big things that we see about Coke is that from 2017 to 2018 to 2019, we have nearly stagnant revenue. 36.2 billion in 2017, 34.3 in 2018, and then 37.3 in 2019. And that growth is really nothing to write home about in the kind of industries that Coke is playing in. So that reflects an increase in competition, the relative ease now of bringing a new brand to market. Coke has had to acquire brands that were competing with it, and the challenges that Coke faces. We still at the same time do see that the cost of goods sold for Coke are the majority of what they sell. And again, as a hint, a branding organization is often a variable cost business. And we see that play out. In 2017, 13.7 billion, in 2018, 13.1, and in 2019, 14.6. And so over 50% of the total cost of the business is held in the cost of goods sold. So because of that, we know it's a variable cost business. We know that their focus is on managing price and quantity. So our focus of thinking about Coke in the future is, will they be able to maintain the prices of their products to maintain that pricing premium? If we begin to erode the pricing premium, if we begin to erode the gross profit of the business, then we end up in this downward cycle of having to spend more money to acquire customers and making more when they do come in the door. It's a recipe for disaster for a brand like this. So what will Coke do going forward? They will continue to brand, they will continue to acquire, and they will continue to release innovative products in order to gather the maximum amount of opportunities in the market. One thing that I do want to note that's interesting about Coke for such a variable cost dominated business is that they have a very large portion of their business that is in that selling, general, and administrative expense. And you see that change year over year is pretty flat. So as Coke grows, if they're able to use the same marketing budgets, around 12 billion a year, and if they're able to maintain that marketing budget, the overheads and everything else that they're doing, and still continue to grow their top line, Coke has a really good chance to be successful on the bottom line. So what are the recipes for success for Coke going forward? Just to summarize, number one, they need to maintain the brand power so that they can maintain the premium price. Number two, they need to continue to acquire and proliferate brands to maintain market share grab. And number three, they need to leverage the spending that they are doing on their overheads and their advertising to drive more customers through the door rather than spending more on it over time. If they're able to successfully do these three things, Coke will be around for a really long time. What we'll do in this episode today is talk about how PepsiCo has built the brands that they've built, what major difference they have to Coca-Cola, how they behave in their strategy and why it matters and why it almost ruined the company when they didn't follow their core values. And then finally, in the future, how PepsiCo is likely to be successful. But PepsiCo is an interesting company, similar but not the same, unique but not totally unique, and has a different history, different story, but you'll see some real major parallels in the companies. Our focus today is best grounded in a little bit of a history of PepsiCo. One of the things that's interesting is that PepsiCo was actually founded within a couple of years of Coca-Cola, and it was developed by a pharmacist and a businessman also in the South, Coke in Columbus, Georgia, and PepsiCo in North Carolina. So between the two of these were similar businesses with similar stories, but that's really where some of the similarities end. At that point, the businessman who began PepsiCo, Caleb Bradham, he ran the business for over 20 years. Instead, the pharmacist that began the Coca-Cola brand, he passed away just a couple of years after creating it. And through a partnership, Coca-Cola was put in through rigorous business processes and more actively managed at an earlier stage than Pepsi was. Both of the companies grew with the US, and most of their business was in the US for a long period of time. But in the 1950s and 60s, both companies made their first acquisitions. Coca-Cola acquired Minute Maid, and PepsiCo acquired Frito-Lay. These represented two major deviations in how the business's playbooks would work going forward. Coke was setting itself up to be a beverages business. And with only one exception, the acquisition of Columbia Pictures, Coke has remained a beverages business throughout its tenure. Frito-Lay, however, represents a snacks business. And because of the snacks business, what PepsiCo was saying was, we are a consumer products business. We are a quick grab consumer products business focused on both beverages and snacks. So with that deviation in business strategy came the difference in the company. Actually, interestingly, also with that major change that PepsiCo made, we saw a big swing in PepsiCo's market share, and PepsiCo became a more viable, active, and threatening competitor to Coca-Cola over the next couple of decades. Since then, both have maintained their acquiring sprees. Coke buying more beverages, Pepsi buying beverages and products to build out their portfolios, to the point where now Pepsi is actually dominated in terms of revenue, product mix dominated in their snacks business. So you can find more Pepsi snacks that are dominated in the world collectively than Pepsi drink products. However, the top selling Pepsi product is still Pepsi beverages. So between the brands, Pepsi is the dominant one, but if you aggregate the categories together, Pepsi is more a snacks company than it is a beverages company. Now, what does this mean for Pepsi's business model? Well, both Pepsi and Coke have the same business model. They're a variable cost business. Every time you consume a Pepsi or pop open a bag of Doritos, those are variable costs. It costs them something to source the product, build the product, get the product to you. And both of them both Coke and Pepsi use distribution channels to get their message or product out to the world. And those distribution channels include stadiums, they include retail partnerships, and they include restaurants. And in the last 20 years, Pepsi has made major inroads in some of the non-retail sectors because of their increase in the brand portfolio, for example, their acquisition of Gatorade, and the broader appeal of Pepsi because they returned to their core. Now, for a number of years after Pepsi bought Frito-Lay, Pepsi lost the core of who they were, and their main business strategy was discounting. Discounting in a variable cost business is a cycle of death because the discounting results in you lowering your price, your competitor not really caring, you gaining a certain amount of market share. That's addictive. If you want more market share, the only way to do it is to lower your price again. And so if you lower your price and lower your price and lower your price, you set yourself up in a totally different category than your competitors, and you reinforce what their brand promise is rather than yours. So in this situation, Pepsi was basically saying, we're not as good as Coke, and Coke was saying, we're the beverage of choice, which Pepsi was saying exactly the same thing as Coke in a totally different way. What Pepsi did that was radical is that they changed their brand story. So about 20 years ago, Pepsi said, we have our own brand. We're a different brand than Coke. We're a new brand, an international brand, a funkier brand. We're going to appeal to different people and we're going to win in that market. And when they started to do that, they returned to their variable cost roots and they said, we're going to build the brand that allows us to command a higher pricing power. And then we're going to run all of our products through that brand and we're going to win. So we're not going to compete solely on price. We're going to compete on story. We're going to compete in a way where when we can maintain our price, it's just a volume game. We maintain our price, we max the volume. If we need more volume, we go get it in a couple of different ways. And so when Pepsi returned to that was a major transformation in the business. What can Pepsi do going forward in order to maintain or even grow its success? Well, we can take a look at their financial statement and then we can talk about their growth pathways. In 2017, Pepsi had net revenue of $63.5 billion. That grew in 2018, 64.7. Coke's did not. In 2019, it grew again, 67.2. So it's growing every year. However, the growth is pretty marginal. We're talking like under 4% a year in the biggest year, and then even smaller than that in other years. So Pepsi is stagnating in terms of its revenue growth, which maintains an even more important focus on ensuring that their profit growth, their operating profit, and especially their gross profit, because they're a variable cost business, is maintained at the same levels. And we see that they're growing about the same amount in their cost of sales every year, 2017, 2018, and 2019. Now, if you look at the ratios of Coke versus Pepsi, you do see that Coke commands a higher price point. They have higher gross margins on the business than Pepsi does as a percentage. That's a concern for Pepsi and something that they still need to maintain and work on rectifying. And they could do that in a couple of different ways. They could change product sizes for the same pricing. They could push more brand power. They could promote cross-selling. But ultimately, that is a concern for Pepsi if they're not able to correct that. However, this is still a recipe for success. We're looking at a profitable business, and the growth in profits is increasing as the business increases. However, when we look at the operating profit line, the operating profit is kind of stagnant. And so one of the things that could mean is that Pepsi is spending more selling general and administrative every year on getting the customers through the door, which Coke is not. So what should Pepsi do to be successful going forward? They've got a couple of choices. They can grow globally, so they can grow and acquire new customers. New people buying their products is one method of growth. Another method of growth is that they can get the people who are currently buying their products to buy more of their products. A third method of growth is to expand their distribution channels so that you could buy Pepsi more regularly in restaurants or stadiums or experiential places, in airports, for example. And using Pepsi products in other places could drive growth. Or they can continue to acquire, so they can add more brands. But Pepsi has to maintain a focus on one main thing. They can't just get more gross profit and then go spend it on advertising if that's not a virtuous cycle. Coke has it down more than Pepsi does. Pepsi has broader scope. So Pepsi has more profit and more products and more categories. I like that. That sets them up for success. But Coke is delivering better on what they have today. So between the two of them, it's hard to say who's going to be a winner in the future. Both of them can coexist. Both of them can be profitable. Coke has a better current playbook. I think Pepsi has the better upside in the long run. We hope that you've enjoyed this case study on Coke and Pepsi, and specifically on how Pepsi is different than Coke and what that means for their brand and their process. We enjoy putting together these Strategy Simplified episodes and would love for you to tell us a company that you want to hear more about by writing us at team@managementconsulted.com. In addition, please subscribe to our YouTube channel and to our podcast, Strategy Simplified. Thanks for joining.